All right, so it is now 10:15 and we like to start on time because we appreciate you joining us this morning. I just want to welcome everybody. We have a special show today and we're just going to jump right into it. So, welcome back to Morning Money Conversations. I'm Andrew Stewart, your inspired financial advisor, and today we're going to be speaking about a lot of different topics. Now, my main thing is helping families and business owners protect what matters and building lasting legacies. My co hosts joining me today are Stefan and Ray McMillan. Stefan, he's an award winning mortgage broker with a passion for empowering clients through some very, very smart home financing. And rounding out the crew today is Ray McMillan. Now, Ray is a retired mortgage broker, founder of the McMillan Group, and now a savvy real estate investor in several countries, bringing decades of wisdom to the table. Now, today, we're going to be diving into how everyday lifestyle choices like how you protect and grow your money impact your wealth, your health, and your legacy. We're going to be exploring the idea that life insurance is more than just a means of protection. It's a powerful financial asset. Not your typical dry money talk we're going to be doing today, just smart insights, fresh perspectives, and a little fun to help you see insurance in a whole new light. So, what I want you to do is grab your favorite drink and let's kick off today with some clarity, confidence, and conversations that really, really count. Now, I am very, very happy to say that today we are joined by Subhastin Kharag, Director of Insurance for Sales at Equitable Life of Canada, who brings over 22 years of experience in helping families, business owners, and high net worth clients use insurance as an asset class. From his roots as an advisor in the York region to shaping strategies for advisors nationwide, Sebastian is all about maximizing value through smart, collaborative planning. He's also a proud dad of four, Sunday board game champ, and never far from a business book and a nice glass of wine. So let's examine the reasons why incorporating life insurance as an asset and wealth increation strategy is becoming so very, very popular. Now, Sebastian, I guess my first question for you today is for many people, life insurance represents protection for burial expenses, debts, and legacy for their family. How do you reframe it as an asset class when you're speaking to these families and business owners?
You know what? It's a great question. First, let me say I'm thankful to be here amongst you fellas. It's a great honor. So thank you for having me here. And great question. And you hit the nail on the head, Andrew. Every time we talk about life insurance, the first thing that pops into mind is, there's money to keep the family afloat, take care of education funding, all these kinds of reasons why life insurance. But more and more, business owners and individuals who are looking at, is there something else that I can do? I need the insurance, but how can the insurance help me to build wealth? And I know Stefan, yourself, Andrew, and Ray are helping your clients to build wealth. Here's another complement to it is using life insurance as an asset class. What does that really mean? It's looking at how do we take money that we have, put it into the life insurance, and there's a number of things you can do. Pull it back out and use it in whatever you're looking at doing, whether it's investments or whatnot, or just sock it in there and let it build for retirement in a really efficient way. So those are the ways that we look at it. And again, it's like, life insurance is there to protect you, but you could use it as a tool to build wealth, all under an umbrella where there's no taxation over the period of life.
Thank you for sharing that. That's a great framework of how clients can now shift the mindset of, okay, assets. We typically look at, your stocks, your bonds, your RSPs, your TFSA, something that we put money into. But now insurance, as you just said, can be something else where people can put their money into that to also build their wealth. So I'm going to pass it on to Ray or Stefan, whoever has their next question, to kind of see what other things that Sebastian can some shed some light on this for us.
All right, thanks, Sebastian. Good morning, everybody. Hope you're all doing well. To the audience, if you've got any questions for Sebastian, please do not hesitate to either put them in the chat so we can ask those questions, or turn your camera off and come off of mute. I mean, we welcome the engagement. This is an interactive conversation, and we are privileged to have somebody here who can speak with a lot of authority on insurance as part of your wealth building process. A question for you, Sebastian. I mean, we've seen a lot of volatility in the markets in the last little while. We've seen the stock markets all over the place. There are many people who are very um, their primary focus is stock market investing.
Mhm.
Can you speak to the the, the, the preference or the benefits, I should say, of investing in investments with an insurance company as opposed to going headfirst into investing in the stock market, whether it be through mutual funds, and which works better in a volatile environment as we're experiencing today?
You know what? That question comes from somebody who understands it deeply, and I know you understand it deeply. So I thank you for that question, and it's a great question because oftentimes we don't look at how does that all help me. I'm investing in the real estate in the markets. Markets fluctuate, especially now with what's going on. Like no one knows if they're coming or going. If we look at par, and when we're talking about insurance in this case here, we're talking about participating whole life, which is something that it's a tool that allows you to build wealth long term. And you really hit the nail on the head in the fact that it's a non-correlated investment. What does that mean? It means you're participating whole life. The investments there they move slowly, really slow. You're not going to have astronomical ups and downs, but if we look at like a 30-year period, you're seeing more of an equity kind of exposure, roughly around 7% rate of return. And it's smooth and steady. And there's this thing in par that's called smoothing. And what they do is they take a 5-year return and they average it out. So you keep the smoothing effect versus the stock market where it can go up and down. So it's a perfect balance. Here's your aggressive side on the markets. And then here's your safety net, your tried and true that you know every day is guaranteed to go up and it can never go negative.
All right. Thanks. Great answer, Sebastian. I appreciate the answer. I know Steph is having challenges with his camera and his Wi-Fi this morning, so I'm not too sure if he's Stefan, are you able to come into the conversation?
Or I guess his mic's
Hey
not.
guys, you can hear me?
Yeah, we can hear
Yeah,
Yes,
you.
we
we
can hear you.
can. We can hear you,
Okay.
Steph. Thanks.
Yeah, there's no camera today. It's just audio, so we'll just do what we have. So, Sebastian, I have a question. What are the most common insurance gaps you see with high net worth households? Like, do you come across, people with high net worth kind of individuals, and what are the kind of common threads you see that they lack in terms of insurance products?
Yeah, you know, that's a great question. Oftentimes, what I see, and we think, you're doing well, you probably have really good advisors around you, but oftentimes we're seeing like half of the population are not being served. They have no idea how insurance can help them. Number two, so they're busy building their businesses. They're moving full steam ahead. They know how to make money in their businesses, but how do they preserve it and avoid, well, not avoid, but reduce the amount of taxes that they have to pay to the government? Because, you face it, we work really hard. Ray, you're in the Sunshine State. We're in Canada here, but you understand it. You work really hard, and then the government's taking so much from you. It can really erode your wealth. So, Stefan, like the big thing is understanding how insurance can help them to not erode the wealth that they've built. I
So,
see
jump in.
Corinne has
We have a
question.
question. We have a question in the chat from one of our members, and this is Corinne. And her question is, maybe it's just me, but I don't have clarity on how life insurance can build wealth. maybe a more specific example for us layman folks. Also, is this strategy more geared to younger folks who have longer time to build?
Yeah, you know what, Corinne? That's a great question because we all know it. The four of us on this line here, we know it. The younger you are, the better your chances of getting the insurance. Because what happens is as you age, things can impact where health-wise, where you can't get the insurance. So it's always best to start as young as possible. The next thing is you have a lower cost of insurance. And if you're using this as a wealth building idea, and I'll give you an example, is you've got a lower insurance cost, you're able to put more, and think of it like a tax-free savings account where there's no erosion on taxes of that gain. So what you see is, and it's something, and I'm going to say, and Andrew can kind of jump in here too, is I've noticed younger individuals. When I say younger, people like in their late 20s, early 30s that are jumping in and purchasing these plans. And you know, they're smart, they're savvy, they've gone out there, they've done their due diligence, and then they're looking to team up with an advisor to help them with that next leg. So, you know, great question. The younger you are, the better. So I'll give you an example. You wanted to build, you know, you've kind of maxed out on our RSPs and other means. Then if you look at PAR, how can that help you? Well, what we do is we overfund the life insurance and allow that to grow without eroding by taxes, the growth. And then you're in retirement now. What you could do is you could say, okay, I'm going to take this and I'm going to take it as a loan to a third party like a bank. And a lot of the banks lend on these policies. And I take it as a loan to myself. Well, what's great about that? Well, number one, it's not income. So you're not paying income taxes on that. And if you look at a lot of wealthy people, how do they structure their affairs? They're not trying to take income. That's the last thing they want to do. So oftentimes you'll see them leveraging these policies, taking it as loans, and then, you know, working with your advisor, make sure you maximize OAS, CPP, and all the government initiatives that you have there to support you in retirement. So it's always looking at how do you augment everything and balance it for the bestness, you know, best results for yourself and your family. I
Yeah,
hope
and that was
that.
yeah, I think you jumped on a couple of things, hit some things there in that response. And I guess just to Corinne, the wealth side of it, it really does, like Sebastian said, what stage in life you're at, right? So if you're in the younger age, then yes, you're looking at, just like everybody else who's gone through life, you're looking at growing your wealth and building your assets. So insurance is another class where that money that you're earning, you can put into it and it grows over time for you. Now, if you're in your middle or close to retirement, you're looking at more of a preserving your wealth. So how do you preserve your wealth, right? You're not worried about, okay, how much income is coming in my retirement years. Well, like Sebastian said, if you have one of these policies, you are now able to use it as a leveraging, taking that loan, taking that money in without affecting all the government benefits that you have, without actually using the money, the cash that you may have saved in your RSPs or your TFSA. So then you're able to extend that money out longer. So that's how it preserves your wealth a little bit longer in time for you. So it really does depend on what stage you're at. How this tool will fit into the whole wealth creation plan. Hopefully that answers your question, but if you have if you have a follow-up question, please text it or feel free to come off mic, and you know, we would love to have a chat with you as well.
And you know,
Um,
I'll kind of jump in there. It's great that you guys are doing this because there's so much not known about how to utilize life insurance in particular, and so you know, helping to educate everyone to understand how do I benefit myself and maximize everything that I'm doing.
Perhaps you can speak a bit more, Sebastian, how the I don't want to say the payment of the insurance premium,
Right.
but the additional funds when you buy these particular insurance products, how they're invested compared to someone who's invested directly into mutual funds or perhaps even the stock market, just to provide a bit more clarity to our listeners.
Yeah, no, that's a great question. So all these companies in Canada have been selling these products for well over 100 years. They understand how to manage it in every cycle. So what you see is they have, I would say roughly most of these companies, 40% is in bonds or high quality government and corporate bonds. And there's a small amount in cash, and the remainders are in private placements, mortgages, real estate, equities, to try to really get a higher result in the performance. So they have this safety and then this aggressiveness. And the other aspect is, before we started the call, we were all talking about it, and one of the things that these par performance investment groups do, what they do is they take the 5-year average and they average it out, and they use this thing what's called like move to market. So what all that means is they're taking gains and losses to balance it, to give you a strong, steady, consistent rate of return. And just to give you an example, like Equitable's performance over a 30-year period is 7.78%. In the 20-year, it's about 6.8. In the 10-year market, it's about 6.4. So you're getting a really strong performance. And how does that relate to the equity market? So if you look at the S&P over that period of time, very similar rates of return. So what's the difference between the two? The big difference is par is strong, steady, consistent growth. The equity markets go up and down. So, and you need to have a balance of both, I think, to try to get where you're trying to go. But if you think about par, think of it as strong, steady, consistent rates of return, and allows you really a safety that if the markets are tanking like right now, you could use the buildup in your par plan, and you could use it. Let's say, for instance, you wanted to get into real estate and you wanted to purchase a property and you've got cash in your policy. You could go and leverage that cash to invest in other investment choices. And the beautiful thing about this is, what most people don't understand is, when you're leveraging it, the policy continues to grow. You're not taking the money out of the plan. So there's a really, what I would say, Corinne, is speak to an advisor, because everyone's different and unique, and it's all about how do they work to maximize what you're trying to accomplish.
All right, we got another follow-up question from Corinne.
Oh.
So she says, so if I already have life insurance, does this mean opening a new life insurance that's specifically set up for this model of wealth building? And then she says, I already have a permanent life.
Yeah.
So
you may not need to. You may be able to use the one that you currently have. It all depends on how it's structured, what it allows you to do. You'd have to kind of look at it with your advisor and figure out, what am I trying to accomplish here? Can I use what I already have? And kudos for actually doing that, because many people, they say like 46% of people do not have life insurance, because when they think about it, it's like, oh, if I die, then my family's taken care of. There's nothing for me. But it's really shifted. And you know what? It's sad to say, in one regard, you're seeing less movement on the family market side. Like, and I'm saying, those who really need to look at it, they're not looking at it. But the wealthier you are, the more you're looking at, what other tools can I use? So you're talking to advisors. You're trying to find out what's the best solution for you. So what I would say is, speak to your advisor, look at your specific situation, and it's just taking it to that next level. And especially participating whole life, it can really magnify the wealth that you're building, because of the way that it's built in. And as Ray Stock alluded to earlier, is that stability of the returns. It's not like anything else in the markets. Let's put it that way, the stability factor. So I hope that makes sense, Corinne.
yeah, go ahead, Stefan.
No, that was a great response. You're dropping a lot of gems, Sebastian. Just going back to earlier, what you were talking about, young folks and obtaining life insurance. I know I'm speaking for a young person myself. I find that it's not in our forefront as, obtaining a mortgage or other asset classes. Can you speak upon that a little further, maybe why that's the case? And how can we have young folks, when they're planning their life or creating wealth, to include life insurance in that plan?
Yeah, that's a great question, Stefan. The big thing is, and it's not even just younger people, but everyone is looking at, the traditional things. So yes, I've got to get a mortgage. I want to buy real estate. I want to get into stocks. I don't know if anyone does those bitcoins and all that, but that's what's out there. But you're starting to see a secondary kind of movement happening. And guys just like you, Stefan, is you're young, you're smart, you're moving radically upward in the wealth scale. So now it's like, okay, what other tools can I use? Because each person has a certain vision of where they want to get to. And there's so many different tools. Like, life insurance is not just life insurance that if you pass away. It's now evolved into a tool to help build wealth and taking it to that next level. And there's so many different ways. So, yes, when you die, of course, that's the need. It provides money. But the secondary thing is, what if I want to use it when I'm alive? What if I want to, I'm working for a company and I decide, what, I want to venture out on my own. Well, you need money to help you to launch out. Guess what? You have the life insurance policy and it's got cash values. You could utilize that to help you launch. And I'm seeing younger people looking at it and saying, like Ray, we're the two old guys on the line here, but all these young people here, they're like, you know what? No, I don't want to, work 9 to 5 for, so many years and then retire and, and that's it. No, I want my life to have some meaning. So really it's using these tools and complementing everything that you're doing, not just one thing, but a multitude of things just for what you actually want to get out of it. So that's what I would say, Ray. Stefan.
Thanks for calling me old, Sebastian. I really appreciate that comment, man. That's a that earns a 10.
Well, we're both in our 45s, 50s, right?
There you go. Thank you. Thanks for the back pedal. Yeah. But great conversation. Thanks for the for the comments, Corinne, and really thanks, John, for joining us. There's a comment from Corinne there, but before we get to Corinne's comment, I want to ask a question. Early on, you mentioned about born against the insurance policy, the investment part of the policy. Can you speak a little more detailed about how that process works? Whether you have to repay the money you borrow, if you don't pay it back, how it affects the insurance policy, and can probably affect your beneficiaries in the future after your demise.
Yeah, no, that's a great one. So I'll do it from two standpoints. Let's say, I'm some young guy like Stefan or Andrew, and let's just say I'm not married. Why would I need insurance? Well, you really don't need insurance because if something happens to you, your family's okay because you don't have a family, you don't have kids, wife, or any of that. But why would you want to use insurance? Well, what I'm seeing is you've got some young folks, what they'll do is they'll say, okay, I've got some money aside, I'm maxing out on this, maxing out on that. What else could I use? And I want to get into real estate, or I want to create something that's going to help me in retirement. So what they'll do is they'll buy the insurance, overfund the insurance, and then you could leverage it. To your point there, if I leverage it, do I have to repay this? And why would I want to leverage it? Well, number one, why leveraging makes sense is because, and I'll give you just arbitrary numbers. I'll use our numbers that we have. So right now on our participating whole life, we're paying out 6.4% on the dividend rate. And the loan, if you were to come to us, the loan rate is 6.5. So it's just 10 points difference. So why would I want to leverage it? Well, the money's not coming out of the plan. So that money keeps growing at 6.4. And even though I'm paying 6.5 to borrow my own money, it's really just costing me 0.10. So where could you get a loan at 0.10? Not many places you can get a loan at 0.10. So number two is, okay, so I've got this loan, I've taken the money out of my plan, and I'm gonna use it in retirement, or maybe I'm gonna take a couple of years off and do whatever I want to do. Do I have to pay it back? No. Well, you don't have to pay it back. You could just let it keep going as long as there's more cash in the policy than what's owed. And what you'll see is that some people, let's say, you know what, I'm never going to get married. I'm just gonna have a great lifestyle or whatever. They would use it and say, okay, I'm not going to pay it off. I'm going to just let it go until I pass away at age 100. Whatever the cash, the loan is at that time will be taken away from the cash values, and the rest of it will go to my family or someone I choose. So you could do it in so many different ways, and so I hope I answered that question there. But like I'm thinking about it, and Andrew's probably at the same part, is that there's so much flexibility. It's unbelievable what you can do with these tools with the right advisor. Corinne said the pros and cons. What I would say is talk to 3 advisors and really get to ask for recommendations. That's the best way, I would say. I know there's a lot of information on TikTok and all these other social medias, but ask for recommendations and speak to the advisor, because not everybody's at the same level. And so you want to work with somebody that understands the complexities of it and what helps you to accomplish what you're trying to accomplish.
Thanks, Sebastian. That was a lot of clarity for us. Thank you.
My pleasure.
There was a question there from Corinna about pros and cons of term versus permanent.
Yeah.
I'll just jump in real quickly on
Yeah.
just my take on that.
Yeah, absolutely.
So what's the pro of term? The obvious one is cost. It's going to be the cheaper of the two, right? So if you're going to look at a dollar for dollar spend on $100,000 of coverage, you're going to be spending less on the term insurance. Term is good because I always equate it to, it gets you in the door. It gives you what you need to do. It covers off what you were looking to cover off, whether it be a debt, whether you wanted it to be a final expense to pay for your burial, whatever the purpose of why you needed the insurance, term is a great way to cover that particular need. Now, the disadvantage of term is that it's going to end at some point. Term is not going to be there with you for your whole entire life, especially if you're going to live a long life. Also, term also renews unless it's a T100. But most people are buying either a term 20, maybe a term 10 for the cost reasons. Now, when it renews, it's going to renew at a higher premium. So you're going to be going through that, although you don't have to go through any new medical underwriting, which is also an advantage. Now, the key thing that most people forget about term is that you can convert your term insurance to a permanent without having to do a medical as well. So there's a couple of key pros that you have with term. Now, with permanent,
sorry.
Go ahead, Sebastian.
No. I thought you had finished, but it's good.
But with permanent, it's with you for your whole entire life. Instead of renting the term, you are now owning your life insurance. So you equate it to you owning your home. Nobody can kick you out. You own it. It's going to be with you. Also, it's also going to grow in value depending on the type of product that you buy. So the permanent side is kind of like buying a house, and the term insurance is like renting your apartment. If you can kind of think about the advantages and disadvantages of those. That's just my take on some of the pros and cons of term. I can go in much deeper, but I'm going to keep it high level.
100% agree with you.
Corinne added to her comment, actually. She was asking more specifically of the 2 products on the wealth building journey. And that's actually a very good question.
It is.
Yeah.
It is.
Yeah. So you need a permanent base. So you could have, a permanent base, a small amount of permanent, and then some term riders, and also allow you to build the wealth. So it depends on how you structure it. But if it's just strictly term, as Andrew said, you're renting it, no, there's not really anything, because you can't overfund it. It's just protection, right? So you know what, Corinne, you've got some great questions. I would tell you, listen, meet with Andrew. He knows the business well, and he can help you with your questions, because you've got some great questions.
Yeah, she certainly does actually, and it's
Yeah,
good to see the audience participating. You
yeah,
mentioned dividends earlier. I'm going to rewind the conversation.
sure.
Um, can you speak to the benefit of of having a policy that pays dividends as opposed to one that doesn't, and whether if the dividends are taken quarterly or annually, is that a taxable benefit? And what's the best way to minimize the tax liability if you've got um, dividends paid to your paid from your policy? The comment from
Hey,
Corinne caught me off guard there.
you gotten some
I've known Corinne for
kudos
like about
there,
20 plus
Ray.
years actually. So I started coming and I started to stutter. Thank you so much, Corinne. I really appreciate that. It is really good to get these thank yous from clients that you work with.
Absolutely.
I mean, I met Corinne probably early 2000s probably. So thank you very much. I appreciate the comment.
Yeah, that is
So
awesome.
did
That's
you
a
get my
testament to
question?
you, buddy.
Because she has me stuttering now. I don't do that very often.
That's right. Oh yeah, so on the dividend side, yeah, it's a great question. So you've got and we're talking about par policies here because they're the ones who give you a dividend. When you think about it, a par policy is when you buy a life insurance from a company, and we'll just speak to ours, for instance, Equitable or a mutual. So when you buy a policy with Equitable, that's a participating whole life, you are in fact an owner of the company. So when you're receiving these dividends, so we go out, we make these investment choices depending on the expenses and claims and all of that. We'll come back and say, okay, over the year, did we have a gain or a loss? If we have a gain, we give a dividend. And just to give you an example, we have always paid a dividend for the last 100 years. And most of these companies that have participating whole life plans, they've always paid a dividend in that 100-year period. So it's not like we're unique. All these companies know what they're doing. It's just a little difference because we're a mutual. So when you receive the dividends, you can do a number of things. You could say, okay, you know what? I'm 40 now, or I'm 45, and the dividend is 8,000 a year. Send that dividend to me, and that's going to help me with, let's say, a trip a year. It could be taxable, a portion of it, not all of it, as interest. Next thing is you could say, well, you know what? Instead of doing that, why don't you keep growing my cash? If you do that, then there is no taxes at all. Because remember, we don't want to take income. We want to take loans to augment our lifestyle. So we let it continue to build because there is no erosion by taxes. So as it continues to grow, now I could say, okay, you know what? I'm 50 now and I want to retire. And I've got enough money that will allow me to take loans every year to take care of my lifestyle. And I don't have to, or maybe I can do a part-time job, or maybe I can jump into a side gig that will balance everything. So you could do it that way. So not creating a taxable income, allow it to continue to grow. And as long as it's within the policy, there is no taxes whatsoever.
Thanks, Sebastian.
You're welcome.
It's interesting you keep mentioning the loan stuff all the time. And I
Yeah.
need to understand, like I'm on the investment side in the real estate space. It's my love, and I was talking about it yesterday about leveraging equity in real estate to minimize taxes. The great thing is to have cash flow in real estate. So I'm a cash flow investor,
Mhm.
but cash flow increases my tax liability, right? If I've got 10 rental properties and I'm earning $500 from each rental property net of expenses, I'm earning generally $5,000 a month, $60,000 a year of net revenue from these properties, right? And I'm paying tax on all that money. However, if I can leverage my real estate and refinance them periodically to consume all the equity in those properties and then take that cash out at my convenience, whether it's, I've got 4 properties, they're worth $200,000 each. I've got $100,000 mortgage against it. They're all positively cash flowing. I refinance it to the maximum, which in this case would be what, $160,000, I think, or $160,000. I take $60,000 out of each of those properties. I have now got $60,000 tax-free in my hand.
100%. 100%.
And the exact same principle.
Yes.
So I'm learning here from you, Sebastian, that the exact same principle applies to insurance as an investment component, because I primarily saw insurance, life insurance, as protection.
Yes.
I've got liabilities, I've got dependent children, I've got people who depend on me and my income for their everyday survival. I never really focused a lot on the investment part of the life insurance policy and how to leverage it, as you keep mentioning so often, and enjoy the asset with minimal tax liability. So I really appreciate the clarity you've shared with us here today.
Oh, my pleasure. And yeah, there's so much to it. And it's the good thing is more and more people are opening up those conversations. Before, like when I first got into the business, you talk insurance, you're gone. Like, oh, I got to go somewhere else. People run away from you. But today, it's not that way at all. Everyone's looking at, okay, how can that help me? So there's more willingness to look at it for sure.
Yeah, Sebastian, this has been great. I always admire how you tackle the questions and tackle, situations on educating people. I just want to get your perspective from, and I know you can't speak for Equitable, the company in itself, but the appetite of how insurance companies look at wanting to sell these policies to individuals of, what is this something that we actually want people to do, looking at their life insurance policies as an asset class? Can you just briefly just talk on, like, has there been any shift in, like, how the insurance companies are looking at that as far as individuals buying these type of policies, and whether it's promoted or looked or frowned upon? Just
Yeah.
your take on that.
Yeah, you know what? We've just launched a piece with one of the most brilliant actuaries in Canada. And he created this white paper on that same topic in 2012. We, in collaboration with him, have released that paper again, refreshed, and from a mutual standpoint, is exactly that, using life insurance as an asset class, as an investment. And it's really geared to where the market has moved to now. More and more individuals are using insurance, not for just the protection part of it, but the wealth building side. So companies really like that business. It's strong business, and it's something else that they can offer clients for that safety side and the wealth. And you know what? There's this thing called the hockey stick effect, where it goes gradually, and then it just upticks. The longer you have it, the faster the growth over time. And so they're more apt to doing that. And again, there has to be at the bottom of the day, there has to be a reason for the life insurance, and you have to be able to qualify for it. So if you have the need for it, you've got the money, but the health is not there, it won't work. But and that's why, to Corinne's question earlier, the younger you are, the better. Even if it's term, like Andrew said, you set it up as term, get yourself covered. Now you can always upgrade it to permanent down the road, right? So it is something that we promote actively, and we're seeing a big movement, especially in the corporate side and wealthier individuals. Some of these people don't really need the insurance, but they're choosing to buy it because of what it has and what it allows them to do. And again, remember, life insurance in Canada is tax-free. When you get that payout, there is no taxes on it. So it's just really using that to maximize your wealth.
Wow, this has been good. We're 5 minutes towards ending, so we just wanted to open it up to anybody who has a question. Final comments. Stefan, do you have any additional? I know you've been having some issues with your internet, but if you wanted to chime in with any comments or questions finally, please feel free to do that. We got 5 more minutes to go.
Yeah, I was listening to the whole conversation, although I have some video technical difficulties, and Sebastian has been very insightful in this conversation, and I can see people participating and gaining something from what he's sharing. I'll leave it to the audience to close it out. And if everyone wants to take the floor, the question, it's all yours.
This was a really good conversation. I actually enjoyed it. I learned quite a bit, you know. My recommendation though is if you're younger, below the age of 35, and you don't have insurance coverages yet, you might want to consider speaking to an advisor, speaking to Andrew, and get that stuff in place. I remember buying my first insurance policy around when I was probably in my 20s. And I know what the premiums were like then. And then a few months ago, I actually took a look at what some coverage was going to cost me. And it was like a car payment for a nice car. You know what I mean? I was completely shocked. So yeah, if you're young, you're in great health. We've all got an expiry date. And the insurance today is a lot more than just death benefit. It's actually a tax strategy for those who are planning to really step their financial game up.
I just see Dr. Vibe, and I love the tagline there. He's got this question, and it's true. It's a great question. And I'll give you an example. In the markets in 2008, the markets tanked 32%, minus 32%. Guess what par performed at? 8.4. The following year, 8.4. The following year, I think it was 8, and then it went to 7.8. So gradual movement. And you know, if you think about it, these companies have been around for 100 years, and they have gone through everything, and they're still around because they're super conservative. They look at, you know, diversification in a massive way. And if you think about the par fund in particular, where can you get private placement, mortgages, equities at this level? You've got to have at least $10 million to get in to those kinds of funds. Here, with maybe $100 a month or $200 a month or whatever, you can get into that space. So that's really impactful, is that ability to get in to a par fund of that size.
That's a great point. You have to be, what do they call it? A sophisticated investor. You've got to have the network and all that
That's
kind
right.
of stuff to get it. So the insurance company allows you to be a sophisticated investor without having, you know, the large network. Yeah.
Absolutely.
No, that's actually very, very good.
Corinne, you're right. You know, you're lucky that you met Ray, because you understand everything here that he understands. Yeah, sometimes people think, oh, you know, I shouldn't get insurance for the kids. But imagine if you started your child, let's say it's just $100 a month, and you started them when they were newborn. By the time they're 30, do you know how much money is growing in that insurance plan? It's phenomenal. And then if you continue to allow it to go, and I'll give you an example, is you put $100 a month from a newborn, by the time they're 65, there could be about $3 million there in growth, because what? There's no erosion of the growth by taxes. So great comment, Corinne.
I have a last question now about insuring children.
Yeah.
Let's say you've got 2 young kids. Can you insure them both on one policy? Is that possible? They have to have their own individual. If you have like a policy that has the investment options.
Yeah. No, good question. Not
Individual.
with us. It would be individually.
Individual.
Okay.
Yeah.
Okay.
And they kind of have to be equal too. So the insurance
Yeah.
companies will ask you, okay, how much are you insuring on one child and how much you're insuring on the other child? And they should be equal.
Okay.
Yeah.
You can't over-insure
You
one
can't
child and underinsure the other.
Yeah.
Okay. Well, thanks, guys. I
You're just trying
appreciate
to make
it.
sure that you're not trying to off one of your kids.
Oh man. That's a whole
Even for children,
Yeah.
health matters. Yeah. Yeah.
Yeah.
You know what? At the end of the day, that's what they're looking at. They're looking at, are you healthy? And most companies are looking at, you know, they need 15 years to make money on these plans. So they want to make sure that, you know, there's not health issues that will affect your health in a way that you're going to pass away too early. Right. So yeah, 100%.
Great conversation, guys.
Yeah, great conversation, guys. Like what
Yeah,
you're doing is commendable. You know, having conversations, because sometimes people are resistant to talk about it. So this is a great forum for that. So well done.
Yeah, thank you. Thank you very
Thank you
much.
for having me.
Thank you. So we're at exactly at 11 o'clock. I just want to say thank you, Subhastin, for joining us today on our morning money conversations. Like we said, you've dropped a lot of knowledge in a different way where people can take it in and understand it. And hopefully we can bring you back again
I love
to
it.
continue this conversation.
Perfect. Have a
Right.
good one, everyone.
Thanks a lot, everybody. Have yourself a fantastic day wherever you are. Make the best of
Thank
it.
you,
Make it
everyone. Thank
productive
you.
and worthwhile.
And thanks for all the questions, Corinne
And Dr. Vart.
and Dr. Vibe.